And welcome back to another episode of Pain Points, where the world meets business, where we jump into marketing, brand, entrepreneurship, all for you as you're building your business. One half of the team here, Darius Bell. I got it right this week, along with
let's go.
Jagoras.
What's going on, man? Happy Monday.
Happy Monday indeed. A lot going on in the world as usual.
There is, but I wanted to kick it off with a topic that we brought up on the last pod, right? So We've been talking obviously a lot about economics, what's happening in our economy, the end of a 100-year cycle. And I brought up this idea of Keynesian economics versus Austrian economics. And I actually don't believe many people are familiar with the two different schools of thought. So I wanted to break those down today as a kind of a helpful touch point that'll set off the couple stories that I have laid out on the economic front, and then allow us to dive into entrepreneurship, marketing, and brand. Sound good?
That sounds great. And I just want to affirm your notion of like most people don't know, because I'm 35 and it wasn't until I was 31 that I had even heard the term Austrian economics.
Yeah. What does it mean to you when I say that?
I immediately go to personal accountability, personal responsibility, small government, and the people ultimately figure out the solutions versus a major apparatus like the government.
Yeah, that's basically the concept. The concept is big government economics versus small government economics. So Can you see that?
I can. I'm going to zoom in on it though a little bit. There we go.
Get extra big. Okay, so I had ChatGPT help me organize this so that we could stream through it pretty quickly, but it's broken down by a couple different core topics. So the role of government intervention, business cycles, saving and investments, market prices and interest rates, economic calculations and knowledge, inflation, and the view on money supply. Nice. Sound good?
That sounds great.
Okay, cool. So we'll just read it word for word. So Keynesian and Austrian economics represent two distinct schools of thought, primarily differing in their views on government intervention, the role of savings, and how economies self-correct during downturns, that being the most important one there. So let's talk about the role of government intervention. So in Keynesian economic, it's named after the kind of originator of that school of thought, Keynes. Keynesian economics advocates for active government intervention, especially in times of economic downturns. Keynesians believe that fiscal and monetary policies can help smooth out economic cycles, reduce unemployment, and stimulate demand. On the opposite side of the token, Austrian economics or Austrian economists emphasize minimal government intervention. Austrian economists argue that the government interference disrupts natural market process and that recessions are necessary to correct economic imbalances. They advocate for free markets with minimal regulation and interference. So based off of that, what type of economy would you say that we have here in the United States?
I can tell you what we have. We definitely have a Keynesian one.
Yep.
Right.
Yep. That's it. And it's based off of this concept that's known as like the trickle down theory, that if we throw money in at the top by printing, that it will move its way down through the economy and fix the problems. Mm-hmm. So number two, business cycles. So what do Keynesians believe? They believe that recessions occur because of insufficient demand. To counteract, they suggest using fiscal policy, i.e. government spending and tax adjustments, and monetary policy, adjusting interest rates and money supply, to stimulate demand and prevent long-term economic stagnation. Austrians argue that business cycles are caused by excessive credit expansion and artificial lowering of interest rates, which lead to malinvestment. According to Austrians, recessions are a natural correction of these malinvestments, and the government intervention worsens the recovery by propping up insufficient businesses.
We saw that. We've seen that, right?
Yeah. And what would you call me, a Keynesian or an Austrian?
I mean, you're definitely an Austrian, even though you're Greek. You're an Austrian.
Well, and that's because you've heard me say that cheap money allows bad ideas to persist, right? This is a prime example of that. And the only way out of it is to inflate the debt away or cut government spending, which is nearly impossible at this point, or adjust the taxes, right? So if you're just looking at kind of the two political parties at the moment, right? Mm-hmm. One wants to do more government spending and the other wants to actually cut taxes on the people and use other things like tariffs and whatnot, remove certain government programs in order to offset the economy, right?
Right.
So basically you have one camp that's Austrian and one camp that's Keynesian.
Well, you said something, you said cheap money allows bad ideas to exist.
Or to
And
persist.
And then I mean, just thinking about it too, it's like I don't want to say free money because nothing's free, but even if you think about an overabundance of money also gives way for bad ideas to exist and persist. And just listening to that, reading that, it's like, wow, there's this notion of like fiscal irresponsibility that almost exists in this Keynesian space.
100%. I mean, and it is almost free money, right? Because if the interest rates are fictitiously kept low and they're continually driving money into the economy, that's inflating the dollar at a rate that's higher than the cost of capital, or i.e. the debt.
Right.
And so that's why you've seen like real estate, for example, scream at such a rate that it has over the last 20 years.
Right.
So this is bullet number 3, saving and investment. So I think this is actually kind of the linchpin of why I disagree with Keynesian over Austrian economics. So Keynesians maintain that high savings can lead to economic stagnation, as money that is not spent reduces demand. Keynesians advocate for spending during recessions to boost demand, even if it involves government deficit spending, which, golly, we're doing that like nobody's business.
Mm-hmm.
Austrians view savings as essential for economic growth, as it provides the funds necessary for investment in capital goods, which drive productivity. Austrians argue that investment should come from real savings, not artificially created credit. And so how do those two schools of thought play out in the real market today? We have post-World War II, since then we've had a consumer economy, right? And I've even heard one person arguing against tariffs, saying that's just going to make everything more expensive. Think about the phone that you're going to buy, the clothes you're going to buy, the house you're going to buy. It's just going to make it more expensive. And so he's talking about all consumerism. Like, nobody needs to get a new iPhone every year. Nobody needs to move that frequently. Nobody needs to buy new clothes that often. We've been conditioned to just spend and be consumers, right?
Right.
Where Austrian economics says, hey, deploy capital in a way that actually drives the economy, create jobs, provide housing for people. And if you do that, you'll receive the maximum benefit of the tax code. But you don't get to just go take out a bunch of credit in order to do that. You have to be judicious and a good fiduciary in order to be able to play that game, right?
Yeah, there's principles, systems, and rules that still ground you. Like you don't get to just. It sounds to me, when comparing the two and thinking about the moving parts, one is creating an excessive space for emotionally driven decisions, which we know don't bode well for wisdom.
Well, and what does savings require? It requires personal responsibility.
Right.
It requires you to be judicious in your spending.
Right.
Okay, so bullet number 4 is market prices and interest rates. So Keynesians view prices and interest rates as sometimes needing adjustments through government policy to maintain economic stability. They argue that market prices can be sticky, meaning they don't adjust quickly enough to clear markets. Austrians believe that prices and interest rates should be determined by the market without government interference. Austrians argue that natural interest rates emerge from the balance of savings and investments, and that interference distorts capital allocation. So one of the things that I think is most interesting, right, in our current Keynesian environment, we cut interest rates. And when we cut interest rates, they adjusted temporarily, but they've now gone back up and above where they were before. So in a way, the market will do what the market will do.
Yeah, you're delaying the inevitable by way of your decisions.
Correct. You're just kicking the can down the road and creating a bigger and bigger super bubble, effectively. Okay, number 5, economic calculations and knowledge. So Keynesians tend to rely on aggregate data and models to make macro predictions and policies. They believe that experts can intervene to improve economic outcomes, where Austrians argue that economic calculations are best left to individual entrepreneurs who operate based on localized knowledge. Austrian government cannot efficiently allocate resources because it lacks the dispersed information that only market participants possess, i.e., market makers, i.e.
Mm-hmm.
capitalists, i.e. entrepreneurs.
Mm-hmm. I
Number
people
6,
who understand risk and are in the game.
correct. Number 6, inflation. Keynesians see inflation as something manageable through central bank policy, balancing between inflation and unemployment. They call it the Phillips curve. They are generally more tolerant of moderate inflation to encourage spending and investing. Austrians oppose inflation caused by central bank policies, believing that it erodes savings, misallocates resources, and leads to boom-bust cycles. Austrians advocate for sound money, like the gold standard, to prevent artificial inflation. That's why so many people who are like Bitcoin advocates, right, are effectively saying stop pricing things in dollars because that is not sound money, and start pricing things in Bitcoin. And you'll realize that it's a better place to save your money.
Wow.
Number 7, view on money supply. Keynesians support flexible monetary policies where central banks control money supply and interest rates to influence economic activity. Where Austrians favor a limited or fixed supply of money, Austrian economists argue that expanding money supply distorts the economy by creating unsustainable booms, which eventually lead to busts. Basically, they're saying that your dollars should be an asset. Cash should be an asset. But with Keynesians, they believe that it's not an asset, and they want you to spend it and push it out of the economy as much as possible, because that's the flywheel, right? Money needs to be deployed, right? But if you're a saver, then you're punished for that type of activity.
Interesting. The way I try to analogize that in my mind is, so Austrians think cash is an asset. We know that assets ultimately strengthen the person who has accumulated them.
Yep.
Whereas maybe in the Keynesian, you could equate it to, they view cash or dollars as fuel.
Correct.
But in fuel, what happens with fuel? It's always used up. It's always consumed. It's burnt, right?
Yep.
So let me ask you this: how do we? The one question I want to ask is like, well, how do we get here? And I immediately go to moving off the gold standard, like it alluded to.
Yep.
But is a pivot possible for a nation of our size and diversity and all these different, components? Can a nation begin to operate more fiscally, moving towards an Austrian way? Is that possible?
I think it is. I mean, it comes down to the administration. It's not going to be fast nor quick, and it's definitely going to be a painful transition. Ultimately comes down to, what do the people actually want, right? The problem is we keep playing the game, right? And so, and this is the fine dichotomy, and probably the lesson for entrepreneurs today, which is, it's one thing to be idealistic in that, man, Austrian economics would be better. But the truth is we live in a Keynesian economy. And so
Right.
You got to play the game. You have to deploy. You have to leverage debt. You have to be able to use those things in order to go and grow and build wealth. Because if you're just a saver, and we talked about this a couple of weeks ago, how it's nearly impossible to scale without some sort of outside economic contribution, like debt or equity, raising money for that matter. And this is a prime example of that, right? It's because the market is inflating faster than you can keep up. So you want to buy and own real estate? Well, you either just better be really patient until the next bust cycle happens and just stock up on a ton of cash and know that your business is really not going to grow, or you're going to go leverage debt.
Yeah, it almost sounds like you could maybe in their business life realize that you're in a Keynesian system, so operate in that as best as possible, bringing in some Austrian principles. But in your personal life, you probably need to be positioning yourself along the lines of Austrian principles. How can I make sure I'm stronger in these ways that are going to endure through time? Because that's the one thing that strikes me from reading that from ChatGPT is, one is set up for the winds and waves that will inevitably come, and the other might get through it,
Yep. So, quick summary. In essence, Keynesian economics prioritizes demand stimulation and government intervention to smooth out economic cycles, while Austrian economics focuses on market self-regulation with minimal intervention, emphasizing that recessions are necessary corrections to previous distortions, meaning all things return to the mean.
Yeah. That was actually one of the things that I've learned to embrace. The word recession has it's almost like a boogeyman word in our society, where where it's like, oh no, a recession. But anybody who's maybe super affluent, who's done some things the way you want to in business, that has age on them, they will literally always tell you like, no, this is something it happens, you get through it, you navigate it, it's inevitable. And in fact, you can use it to be for a more opportune future if you understand it.
Yep.
So
I tend to try to not pontificate or make major investment or business decisions at the extreme, right? So if I'm feeling like the market is reaching, max peak and it's due for a correction, like I just assume just stand aside and just wait for a correction. But there's a ton of time in between, right? When the market is right for you to be able to jump in and play. But sometimes you're already in it, right? So you don't really have an opportunity to work through it and keep pushing forward, right? You can't just pause, right?
yes.
To be assertive and make a plan and work the plan and execute the plan. And, there's some of the things like we've talked about that would be examples of that, of like right now, business owners have pulled back on marketing, right? That just opens up the inventory, makes it cheaper, and just creates a huge competitive advantage for people who know how to market to steal market share, right? And that's one of the things you and I are really good at, right?
Dude, I feel like you would legitimately change multiple generations potentially by teaching this to younger people. Like,
Well, hopefully they can hear it on the podcast.
yeah,
I don't.
I'm just
It's
like,
just
wow.
not. It's not taught in schools. It's not really communicated unless you're maybe do a stint in economics or finance. But even then, the whole space, like even like finance degrees, are taught like this is how you use leverage, and this is how you determine your return on investment, and
Right.
own assets, deploy capital.
Yeah, I'm going to go on my Joe Rogan for a second, because this is why people are so distrusting of the things we're seeing today. This is also why the quote unquote conspiracy theorist continues to just further accumulate, because you can see that like there's information out there, there's knowledge and people and all of these things out there that for such a long time has just been ignored or kept out of our purview to our detriment. And it's like, well, why would that happen at the same time where it's supposed to be these technologically advanced people who are so caring and so loving and all about the flourishing of humanity, but yet what actually helps us has been under wraps? Well, because it's probably a concentrated few people who want you to be like, it's just like this. I mean, we know what we know because of what scripture tells us, but it's just, man, it's like, this is why people are waking up and they're like, this is crazy.
Yeah, they've experienced it long enough now, right? If you're a millennial who you're the largest segment of the workforce, you've experienced it long enough to know like this cycle is not good and it just continually perpetuates. And eventually you need some sort of major correction for it to happen, for it to unwind itself. And then the cycle repeats itself all over again. We don't learn anything,
Yeah. Roger that, man.
Well, so segue off of that, I want to bring up this next story because it's just as pertinent or important. It really like actually plays out. So I'll pull it up here.
Okay.
It really plays out what we're talking about, which is what happens when Keynesian economics goes wrong. So this is a headline that came off the Real Deal, which is, if you guys don't follow that, it is like kind of, we'll say the news, the scuttlebutt on all things real estate, all the way down to celebrity drama, almost like celebrity developers. But this one's a big one. So this one says banks multifamily delinquencies skyrocket 990%. It says, I think it's bedraggled by rent, regulation loans, NYCB sees storm clouds ahead. And I'm going to try to paraphrase as much as possible. I'll read quick. New York Community Bank is working hard to right the ship, but the 2019 rent law is relentless. The Long Island-based lender saved from the brink of collapse in March of this year, 2024, reported a 990% surge in delinquent multifamily debts year to date, which means they're not getting their loan payments, marking 1.5 billion as not accruing interest in the third quarter. And this also means that those people that own those loans are coming in and trying to renegotiate. About half of NYCB's multifamily loans are tied to rent stabilized properties choked by revenue restrictions in states' rent laws. So they're saying that it's due to the fact that there's restrictions on rent growth, but truthfully, the market, in my opinion, can't handle much more rent growth. In fact, we've seen rents decline. So the surge in delinquencies comes as NYCB said it effectively finished the review of its loan book. It promised after disclosing the weakness with internal loan review. The bank nearly quadrupled its loss reserves in response to the surge in distress, bringing its provision for loan losses to $242 million in the third quarter and a projected $1.1 billion to $1.2 billion for this year. The metric is reported as inexpensive and delivered a blow to NYCB's earnings. The bank reported that a net loss of $289 million or 79 cents per diluted share compared to a profit of $199 million or 81 cents a share a year ago. So this goes back to what we talked about last week with Warren Buffett, Charlie Munger, right? Mm-hmm. Held to maturity. Who's the loser here? The loser here is ultimately the bank shareholders, right? Like, where are they getting the money to deploy? They're deploying bank shareholders or people who are bank with that bank. They're deploying their money, which means that money is not coming back to them. So this is where like Keynesian has a negative effect is now there's some sort of government intervention that has to step in order to save the bank, or they'll let the bank fall apart. The bank gets bought out, gets consumed, which creates a whole other host of problems, which is potentially a monopoly on banks, right? All the big banks roll up all the smaller banks and credit unions. And now all of a sudden we lose our choice of banks that we get to choose from.
And not only do you lose your choice, you can't do anything about it because you got wrecked.
Correct.
Wow.
Exactly right. So that kind of takes us to third of the day, which is from our boy at maybe it's a girl. I don't know. I doubt it. Bravos Research. Just by the way things are written, it doesn't seem that way.
Don't you say that again.
Bravos Research on Twitter, who's a great follow. He says the Sahm rule has been triggered. It predicted the last 9 recessions with 0 false signals since 1960. This one on well a threat. So what the trend, what the chart is showing is these spikes that are basically the Sahm rule recession that from 2020 to 2024, we had this massive spike. Every one of those spikes has led to or predicted a recession. You can see 2008, 2000 dot-com bubble, 1987-ish savings and loan crisis. So the thread goes on to say 2007 unemployment rate rose by 0.5% in the 6 months leading up to the 2008 financial crisis. The unemployment rate also rose 0.5% in the 6 months leading 6 months before 2001 recession. Today, in the last 6 months, the unemployment rate has risen by 0.5%. Again, the latest data point came in at 4.1%. Since 1963, such an increase has occurred near recessions. She's highlighting all these red lines. As the U.S. unemployment rate climbs up, recessions tend to follow. The unemployment data has also triggered the Sahm rule, which has a track record of predicting the last 9 recessions with no false signals yet. The Sahm rule is a recession indicator created by economist Claudia Sahm. It identifies onset of recession by tracking rise in unemployment rate. The rule triggers if the 3-month moving average of the unemployment rate rises by 0.5% or more above its 12-month low. Currently, the Sahm rule sits at 0.57, indicating that a recession is almost certain if history repeats itself. Even the labor market conditions index has been declining steadily, which has often been a precursor to recession. So this looks like that chart basically upside down.
Mm-hmm.
labor market conditions declining, unemployment rates increasing.
Wow, dude. I look, when I'm reading, and I'm taking this in from you and from them, I just can't help but think like, wow, it is, excuse me, it is tough times ahead, man. Like that's just the best way I can put it. Like, and I tend to think about people who aren't even having these conversations,
Right.
well-meaning people, well intelligent people trying to do noble things. I got a couple friends that immediately come to mind every time we go down this path because they're the same people who would be like, I don't go on X because it's a right-wing MAGA pool. And and they're friends of mine, and they know, even despite them knowing who I am, they still feel that way, right? And but it's like the platforms you're on, the spaces you're in, you're probably not having these conversations, but they can make such a difference in your life if you take this information and apply it.
Well, that's why we do the pod. But
Right.
I think the reason we talk about economics so much is just it is very relevant, right? You're as a only the paranoid survive. You're always preparing for winter as a business owner, as an entrepreneur, and so you got to be looking at these things. And so we might get through 2025 with no negative recession, right? We also know that like coming off of any kind of election, that you tend to see the market go up one way or the other because it's just thankful that the election's done, right? And then you see all the policy play out over the next couple of years, and that's really what determines whether or not this ends well.
Yeah.
So you can't control any of that.
No, and I really love that there are people like them out there putting this stuff out and it's available. It's not behind paywalls. It's not behind,
Right.
Admission tickets and anything else. And it's what a time to be alive, to be frank.
Exactly.
Well,
So it's a
well,
good segue after that. You brought one that comes from another good follow on Twitter, SMB
yeah,
Attorney.
SMB Attorney indeed. So, SMB Attorney, what's Eric? Is his real name Eric?
Eric Pacifici,
Yeah,
I think
that's
is
right.
his actual name. Yeah.
Yeah. So, I came across this morning, and this is a compliment to. This is a quote on top of this post, which I want to dive into. So, can you see that just fine?
Mm-hmm.
Okay, so let me solo this out. So he says, this comes from Colin McClelland. He says, a friend told me about their company being acquired by two 30-year-old MBAs with a search fund and absolutely running it into the ground. Said they're smart guys, but extremely inexperienced operators and now losing their top execs and talent. Whoever thinks acquiring businesses is the least risky way to build wealth or generate returns clearly doesn't understand the underlying risks of acquisitions, right? So SMB Attorney came across that, and he has a great post here that I just want to highlight. He says, buying a business is inherently risky, as is all entrepreneurship. I stress this constantly, both here and in conversations with clients. Many of the buyers we work with are experienced and well aware of these risks. However, it's crucial to recognize that not all buyers are the same, nor do they carry the same risk profile. Some buyers are some buyers acquire high quality businesses, those without heavy reliance on one person or customer, and rely on sound transaction practices like conducting a quality of earnings analysis, along with solid legal structuring. Others take on higher risk ventures, such as restaurants where challenges can be more significant. Statistics make it clear buying a business has a significantly lower failure rate than starting one from scratch. That's simply a fact. But when a business acquisition does fail, especially with personally guaranteed multi-million dollar debt, the impact can be much greater. Does this mean everyone should buy a business? Absolutely not. In fact, entrepreneurship isn't for most people. In the ETA community, that's entrepreneurship through acquisition, for those of you who don't know, most buyers we see are doing reasonably well, not crushing it, but holding steady. Doing fine in this context means they're responsibly managing debt, building wealth steadily, and fighting the same relentless entrepreneurial challenges as those who started from scratch. If you ask the sellers, though, you'd likely get a different story. And that's the point he's trying to point out. Is like, hey, this guy's sharing from the seller's perspective, but you'll likely get a different story with claims that buyers are struggling or running the business into the ground. That's natural and often anecdotal, not necessarily the full picture. There are also significant demographic differences between most buyers and sellers, which often leads to misunderstanding and disagreements. This is why I encourage my conflicts to only roll equity and take partners when absolutely necessary and well vetted. Am I saying the anecdote below is wrong? Not at all. I have no insight into the situation, but relying on one conflicted account from a seller and passing along its condemnation of an entire entrepreneurial path is a bit much.
I agree.
Yeah.
I can speak to it firsthand. So we recently bought that excavation company, and to be candid, the former owner is an incredibly greedy, self-righteous, indignant prick, for lack of a better term. And he thinks that we're just some idiots with no experience. And, he thinks he's just the man. And, but you look at his whole life, and his whole life is structured that way, where he's the king of the castle. Right. And so, post closing, and Eric will say this too, like, you're only as good as your operating, or excuse me, as your UPA, your unit purchase agreement, and the words that are written in there. And so, he tried to pull some fast ones on us and tried to think that he could get away with it. And we're going to hold his feet to the fire, and we're fully prepared to go to war. Right. But that comes from years of experience, right? Of just like, that's just a part of the game. Right. And so we spent extra money to make sure we had a good, transaction attorney and have the deal put together. And inevitably I am 99.9% sure that this is going to go down some sort of legal route, but it's just part of the game. Right.
Yeah.
Most people are not prepared for that. Number one. I also saw a post that somebody made the other day that I think was just downright dumb, which was, better than becoming an MBA, they should actually go and become a business broker. That would be a better path to them learning how to operate a business, because they look at a ton of P&Ls. And it's like, no. The best path for you to actually go is to go be a COO, right? Go be a chief operating officer, go be a chief growth officer, go be a director of sales, like orchestrate the business in some capacity so that you can take those chops and actually roll your sleeves up. Because that's the difference, right? Is MBA 30-year-olds look at it like private equity people, but when you buy a small to medium-sized business, it's not just deploying capital. It's roll your sleeves up, and it's leadership, finance, operations, growth, product, service, sales, marketing, right? Where are we weak? How do we tune it up? Where do we cut costs? Let's get rid of this person over here. Let's optimize this over here. And all of those things lead to bottom line cost savings to offset some of the extra debt that you've now taken on in order to operate the business, right? And then everything after that is just sales and marketing, right?
Well, and in surveying those two posts, I think there is something there too of, hey, ETA is the thing right now. It's the wave, right?
Yep.
But to Eric's point, and even to some of the point of the gentleman who made the initial tweet, is it is likely going to be harder than you think. It'll take longer than you think. More pain is going to be inflicted upon you than you desired. But that's not a reason to not do it. And in fact, it makes the case for what you were just talking about, of like, you can only read so many statements and go across so many graphs and look at so many spreadsheets. There's nothing like doing the thing. And all sides, so all sides in a sense are right, but the point being, entrepreneurship is hard. And don't fall victim to the glamorification of it in our society. Well, even if it's the ETA route, because people say things like the failure rate's lower. Well, that becomes the thing. I don't expect to fail. Well, if you don't expect to fail, then you're probably not prepared for the challenges ahead. And you may actually, like this gentleman was saying, be running a business into the ground because you haven't prepared for the rocky nature of operating it.
Yeah, I think the hardest part is just the takeover of people. Like, that's probably where they have the least acumen. They're probably pretty smart elsewhere. But that's the component, right? Is they're looking at you as like, who are you? What have you done? You know what I mean? Right. You've done nothing. Get this fancy MBA. Like, I've been operating an excavator for 20 years. You know what I mean? Right.
Or I was just like the other person. He was invested in me. I don't know you from Adam, right?
Yeah,
in fact, your name's Adam and I don't know you. So it's just, I just thought that was a great post to talk about, because it's sexy right now, man. But
it is. The advantage though of buying a business versus starting up is you have trust with the market, right? And so if you don't go in and change the brand, and you leverage those existing relationships, and you have the team, and you can leverage that to go and grow the business, That's different than when you're starting from scratch, because you have to establish trust with the market. Nobody knows who you are yet.
Mm-hmm.
So that to me is way harder. It's also harder because it's cash prohibitive. You have no money, right? So you're trying to like, where does the money come from, right? So you're trying to turn that over as quickly as possible versus buying cash flow. Now I can leverage the cash flow to pay my debt and go and grow the business. It means that in the short term, I probably take less, but I at least have a salary,
Right.
at least have some income coming in versus a startup. Maybe you don't, right?
Yeah, not always, not unless you're funded by some big boys and doing a bunch of other things.
But that's just like not even a reality. That's like
exactly
0.1% of people.
Further sexification of the whole process, right? Like
exactly.
So the real deal nitty gritty. Well, on that note, I want to transition to this next one you brought about the man who, what is it? The man who.
So this is just interesting. Yeah. So this is actually related to what we were just talking about in a way. The lesson that I want people to actually learn from this is that we grossly overestimate what we can do in a year, and we undervalue 3 to 5 years of consistent hard work and effort. No such thing as an overnight success, even through business entrepreneurship through acquisition. But I just found this to be so incredibly fascinating, this article. We'll try to skim it because it's relatively long, or I should say this thread. It's not an article.
Yeah.
But effectively, this man in 1972 entered a cave chamber 440 feet below the ground, alone and isolated from any natural light and clocks. And for 6 months, he removed all time references, which led to discovery of human time warp and the slowing down of time. He found that without time cues, several people, including himself, adjusted to a 48-hour rather than a 24-hour cycle. In 1962, a French scientist named Michael Srief lived alone in a cave for 2 months with no clock, calendar, or sunlight. He only slept and ate when he felt like it, to see how living without time would affect the body's natural rhythm. Over the next 10 years, he set up more than 12 similar experiments. In 1972, he went back into the cave in Texas for 6 months. His work helped start the study of human biological clocks.
Wow.
A thread. Slow your body's time. Go ahead and scroll down.
Alrighty.
So the gist of it was, we'll just kind of skim over it, but the gist of it was, because there was no circadian rhythm built off of the sunlight, right? Sunrise, sunset, his body started to get into this natural rhythm of, it's always dark, right? So when I feel rested and awake, I'm awake. And when I feel tired, I sleep. And before he knew it, he started to get on this cycle of 36 hours of awake and then 12 hours of sleep.
Wow.
And he felt totally fine. You can see he's all hooked up in these pictures to different monitors and whatnot, because he was actually monitoring his brain waves and his heart rate and all these things. And so what was the craziest thing about it is, because he moved to this 48-hour clock over this 24-hour clock, when he actually got called and told to exit the cave, he thought that he still had a whole other month in the cave before he was supposed to come up. That's how far. So effectively, he got back 30 days worth of time because it was in his head, and was effectively not moving through time as quickly psychologically. And the point in all of this is exactly what we do with entrepreneurship or business or success or wealth or whatever it is we think that we should actually be further along than we really are. And that's because we have no concept of how long does this stuff actually take, right? That's why business number 2 or 3 or 4, you're much calmer about the reality of it, right? You don't feel like you're falling behind. You don't feel like you're off the 8 ball or whatever. So the point is, it's all in your head, but it's just completely fascinating, the psychological and biological connection between time and how we perceive it.
Yeah. That's what stuck out to me, was like, oh, you shift that, your body responds. Like, yeah, that's really neat. Very interesting.
So obviously the sun does something to our hormone cycles and our serotonin and our dopamine and cortisol levels. And so if you kind of remove that, you're not hit with that pattern anymore. I don't know how he would do. Personally, I couldn't be without sunlight for that long. That's just me.
But he was just in a cave in general.
Yeah. mean, when he was down there, he was clearly a different dude, right? Because he was using that time to do research, right? So it's basically like 6 months of pain for him to come out with an unbelievable research paper on the other end of that.
That's pretty neat, man. Thanks for sharing that.
Yeah. So
that's really neat.
Expanding and contracting time. That's one of the things that buying a business does for you, right? Is like essentially gives you a 10 or 20 year head start.
Dude, very impressive. I'm not gonna lie. I want to actually look into it a little bit more because it made me actually want to go into some of the more spiritual components of like darkness and different things, but very interesting.
Very interesting. I mean, just on a small level, we experience it when the winter hits, right? The days get shorter, right? And so I feel personally like more productive during the days because they're not as stretched out, but I'm more rested in a weird way, right? But when it goes till 9 o'clock at night, man, I'm like stretching my days out. I'm jamming in more work, and I'm actually more exhausted.
Yeah, that was actually one of the indicatives throughout that whole thread was like our relationship. I don't say our relationship, but the way we maybe practice this usage of time as a society, and then in a societal subset of like business people, maybe there's a better way to do it.
Yeah, motion and progress, right? I think we tend to confuse like deep focused work with like busy work.
Yeah. And then that better way to do it can shift your sort of internal processing of progress and where you're at and choices you're making, which would affect hormones and stress and anxiety, and which affects relationships and other things and yada, yada, yada. You know, your leadership, your employee. Yeah, very good.
100%.
Very good. All right. So this next piece, we're going to move into the marketing piece. It's funny, you go from something so impactful and like dense of like this to like, let's look at a great ad.
Well, so good marketing though is a way to shrink time, right?
True.
Because it accelerates lead flow equals opportunities, and opportunities equals sales, and sales equals revenue. So
yeah. Well, I wanted to look at this next marketing section. We're going to look at, we're going to lead off with Adidas. So one of the things I've been watching, I've in this season of life, I've started watching more ads. I went through a series season where I was cutting out a lot of ads, just because I was just being a marketer. Sometimes you just get tired of like, did I know the game? I'm tired of it. I'll pay extra to not see it. And so I'm into ads once again, and I came across this. Before I jump in, real quick, will you check your mic for me? I can't hear you anymore.
I muted it.
Okay, cool. I just wanted to make sure that we weren't having any technical difficulties. All right. So this first one here that I'm going to show you comes from Adidas, and it was brought to us by Shabazz Khan on X. And he says, Adidas is on a historical run right now with Anthony Edwards, a basketball player, for those of you who don't know, for the Minnesota Timberwolves. He says they're on the throne right now for the best marketing campaign in basketball. And it's not just this ad, it's their overall approach to working with Anthony that they've been doing really well, I must say. So
good morning. How you doing? Good. How are you? Good, man. Can't complain. So, Anthony, we're just going to go over some quick questions, and I need you to answer truthfully. Okay? I ain't got no choice, Jack. Okay. Let's start simple. What's your name? Anthony Edwards, a.k.a. Ant-Man. Your favorite hooper's favorite hooper. Good. Are the AE1s the best shoe in the game? No question. Good. Now for some harder ones. Last season, did the have an easy route to the ring? Nah, they earned that. The East is tough. With all this new talent joining the league, are you worried someone's going to take your place? These new guys are good. Really good. Is that your final answer? Maybe they'll take my spot. Do you think 2K will ever get your face right? I trust Runner to hold me down. When are we going to get the twos? When they ready. You were in the MVP chatter last year. Didn't that bother you? It don't matter who's on the floor. I'm the number one option. We all know who the top dog is. You sure about that?
Really good in a sense of cultural relevance, asking these questions that people are discussing in their own chat rooms and living rooms and while they're playing the video game. Hey, they never get his face right on the game. These are all great for the person who you're trying to move your products to. It shows I know what you think, but then you add the added element of the polygraph. And what does Anthony actually really think? Is it true? So it creates this suspense that you never even find out, right? If he did score or even took an actual test. But it was a great job of appealing to the target audience really well.
Good.
Really well. Really well. Next up here, I came across this one, and it reminded me, we're still leveraging influencer marketing in various degrees across social media. But we looked at, was it Nick's razors? I think it was Nick's razors and beard oil with, no, it wasn't Nick's. It was Jeremy's razors and beard oil with Nick Freitas on YouTube. And we were talking about how well that did. Well, I came across an old ad from the 90s that featured our boy Trump. And I was like, you know what? If you're going to continue to go after celebrities, and if that's going to be your model, if you're going to continue to leverage agencies for that, you should do it to the likes of what we're going to watch here, and you'll probably have a better shot instead of how we're typically doing it today, where it's just like, hey, this person shows up with your product and we try to be funny, but there's no real story or richness to it. So
can't talk, Donald. Slowly. Okay, that's good.
How much you want for your pot? 500. 600.
Introducing Cozone.com, the place to find computer help and buy what's right for you.
Okay.
Cozone.com, we can help.
it's simple. It's simple, but it's rich to the person. There's the undertones of Donald's personality as it was known in the 90s there. Still relates to the product that the person is trying to ultimately, well, the service in this case, the website that they're trying to leverage. And I thought it did a good job, just like the Nick Freitas did, of just like, who is this creator you're working with, as opposed to just trying to fit the creator, as opposed to just trying to match the creator to the product. And hey, you go show this, you go use this. I'm going to use who you are, bring some authenticity or something that validates that he fits within the framing that we're trying to create. So I thought they did a good job with that.
Yeah, it's motion of progress, right? Like, oh, we're doing influencer marketing versus this person aligns perfectly with our brand. We created a strategy perfectly to align with them to make our product sell or move.
Next up here, we have why we always talk about document versus creating. Well, there was this little product, I think it's called the Kitchen Pirate. I think it's what the name of it is. And they've put together, actually, I'm not even going to ruin it. I'm going to let the video speak for itself, but this is why you document versus create on social media.
That's great. I love that. Shows the evolution of the product, how it came about, which is way more interesting than just saying, oh, that's a cool product. And you're like, wow, this guy had an idea and he executed on it.
Well, and that video had 49.5 million views. Several of them had other couple million, like 7 million, and then several other ones, but it was just documenting that. And I don't even know what that looks like from a revenue standpoint for the business. I looked at their website. It wasn't the best, but it's a process, right? Like, now that they have this audience, they can fix their website. They can get their store and stuff right. But right now, they built the audience interest.
Yeah, and you'd be amazed at what they'll let you get away with if they like the product, right?
Yeah. Okay. Well, I don't know if you watched any football this past weekend, but
college only.
Yeah, that's like where the tried and true is, right? But well, yesterday there was a Hail Mary that pulled off by a rookie quarterback against another rookie quarterback in his team, and
I did see that. It's Jalen Daniels. Jaden Daniels, yeah, out of LSU, right?
Correct. And so why I pulled this clip in is because there's fan footage of the event, and I thought I just wanted to show you this because I think if I work at Nike and I'm sponsoring Jaden Daniels and other players in the team and whatever, there's just so much great marketing material that comes by way that's being produced by people that aren't you, and you can leverage this. But I came across this clip here. that's going viral. And if you look at it, and you can't see it, but I'll make sure you can see it here in just a second. So here we go. So to set the stage, this is the play of the Hail Mary. This gentleman right here, number 29, plays for the Bears. And as we press play, we're going to watch my guy interacting with the fans of Washington. So we have all this pandemonium, but why I thought about it from a marketing standpoint is, dude, if I'm working with Jaden, I'm creating the dopest commercial I could possibly create, because I'm gonna get game footage from the NFL. I'm gonna pull some fan footage. I'm gonna show my guy in the video, because he was taunting the fans, basically like, this game's over, checked himself out of the play, and had to check back in, and he made the critical errr that led to the ball. It's like, bro, you can't make this up, but you can use it and just tell a story. It's
now he's a meme on our podcast.
Now he's a meme. Actually, he's trending on social media because he had to come out and apologize. He came out and apologized for. I was like, just own it, bro. Like, don't apologize to just because your team's mad. Like, just be like, you know what, I was tripping. Won't happen again. But yeah, it's such an interesting time to be alive. If you're an agency and you have certain resources and you have significant resources, there's no reason why you shouldn't be crushing right now. All right. Last two here for us. This one is the tide is turning. So at the end of last night's game, you familiar with Nick Bosa?
Oh, yeah.
Okay. Well, Nick Bosa was feeling himself and the moment, and I appreciate it. Nick Bosa came out, and as you can see here, he popped in on the player interview with his "Make America Great Again" hat, and he's trending online because people were like, dude, who do you think you are? And some people are obviously celebrating it, but the tide is turning. We've been talking about this for going in the better part of a year and a half, of how it's the people that have the business people, entrepreneurs, but it's these people that are influencing, actually getting the courage to stop worrying about the consequences. Like, he's potentially going to get fined, right? It's going to happen because he made a public stance in a way. I don't know if they will do it because it might not look good, but it's that piece of like, this stuff matters. And one, it bodes well for his brand. Two, it's going to potentially bode well for the Niners.
If he does get fined, I'm Donald Trump, man. I'm writing that guy a check.
Exactly. Like, it's that's where we are right now. And so when we think about brand and marketing and conviction, and all these things are converging at this moment in time for us to embrace them instead of worrying about getting canceled, losing followers, losing the brand deals, the endorsements, and so on and so forth. That's that Keynesian way of thinking about brand. Now we're going to step into an Austrian way of like, no, I'm going to own this. I'm going to own this. And I'm going to operate with principles. And so I thought that was great. Yeah. Last but not least, this last one is a thread from Tim Carden. And Tim Carden kills it on social media. He's a brand guy, and he has a solid thread here on Pepsi versus Coca-Cola that came out this morning that I thought would be a good read to just close this out. I'll go through it and read through it pretty swiftly here. But he says, in 1975, Pepsi and Coca-Cola went head to head in the greatest marketing battle in history. I don't know if that's true, Tim, but that's a good way to frame it. Pepsi ran shocking blind tests showing people preferred the taste of Pepsi to Coke. But what Coca-Cola did in response nearly destroyed Coke. I think he meant Pepsi. Pepsi forever. Here's the full story. He says, it started with Pepsi getting crushed. Coca-Cola's empire seemed untouchable. Their distribution was unbeatable. Their brand was everywhere. But Pepsi's marketing team noticed something interesting. When people couldn't see the labels, they actually preferred Pepsi's taste. Show them the Coca-Cola logo, they chose Coke every time. This small insight sparked an idea that would change everything. The Pepsi challenge was born. Pepsi's team went to shopping malls across America, 2 unmarked cups with the cameras rolling. Everyone could see what happened when the labels disappeared, and the results shocked the nation. Pepsi was winning, and the numbers proved it. Their market share jumped from 6 to 14% wherever the challenge ran. By 1979, they closed the gap. Pepsi held 17.9% of the market to Coke's 23.9%. The giant was bleeding. For the first time ever, Coca-Cola looked vulnerable. Their response? Well, a devastating miscalculation. They only ran their own taste tests, over 200,000 of them. The results confirmed their worst fear. People really did prefer Pepsi's sweeter taste. But what happened next was even more shocking. On April 23rd, 1985, Coca-Cola announced they were changing their 99-year-old recipe. New Coke was born, and the public reaction was beyond anything they could have imagined. So there's a picture here. The Coca-Cola took arguably the biggest risk in consumer goods, announcing that it was changing the formula for the world's most popular soft drink. So their phones at Coca-Cola exploded. Don't change this. 10,000 angry calls per day, up from the 400 that were normal. One man, Gary Mullen, spent $100,000 of his own money to form Ode Soda Drinkers of America and organize protests. America wasn't just angry, they felt betrayed. Why? Well, because Coke had built more than just a drink. They bottled memories of first dates and family gatherings, long summer afternoons, and American tradition. People weren't just losing a taste, they were losing part of themselves. Eventually, after 79 days of chaos, Coca-Cola admitted defeat. On July 19th, 1985, Peter Jennings interrupted General Hospital, a primetime soap opera, by the way, to break the news that Old Coke was coming back as Coca-Cola Classic. Then something unexpected happened. The public forgave them instantly. Sales of Coke Classic exploded. The outcry had revealed something powerful. People didn't just like Coca-Cola, they loved it. They'd fight for it. The brand was stronger than the product itself. And this changed marketing forever. He sums it up by saying, strong brands create emotional defenders. When people trust you, they forgive your mistakes. They choose you over competitors. They become lifelong advocates. But here's what fascinates me most. Today's brand battles look completely different. They're not won on TV with ads or taste tests. They're won through authentic content and personal connection. KSI's energy drinks, Emma Chamberlain's coffee, the Kardashians' empire. The game has fundamentally changed, which if you listen to our pod, you know, and you're wrestling with that already. But here's another example. And he says, if you're a founder today, your personal brand is your Coca-Cola recipe. It's what makes you unique, what builds trust at scale. Your audience becomes your defenders, just like Coke's customers in 1985. But you don't need millions in ad spend to get there. Here's how. And he drops a post from Alex Hormozi. So that being said, shout out to Tim Carden. Great post.
Can we watch that Alex Hormozi post real quick?
Sure.
See what he says, just to wrap it up.
Never turned down our boy, Alex.
Our boy.
All right, let's see what we got here.
I don't think everyone should be famous. I don't think everyone should build a personal brand. I don't think everyone should anything. You can do whatever you want. And I have billionaire friends who want to stay anonymous, and they're pretty smart dudes. I do think that from a money-making perspective, it is a time warp. You can just go way faster. That is because you can attract talent at such a higher rate than you could otherwise. You can bring people on who already know your values, know what you're about, have already consumed more content than most people's employees currently know about them and their way of doing business. You can basically pre-train your entire team before they come on board because of the amount of stuff that you put out. And those are just unbelievably valuable things. Not to mention, if you're on the deal side, like for us, like investing in companies, we have so much more trust at the table. It's so much better as a process, having been on both types of deals, like white and cold deals and really friendly deals. Way more fun to do friendly deals. So that's the pros. I don't.
It's good.
Yeah, very much so. Well, that's the marketing and brand section, man.
Yeah, it's good. I love that. A great way to end it. I think what Coca-Cola discovered was they were basically auditing their customer. Like they should have actually done that first before they went out there and tried to recreate the recipe. They should have actually forget the taste test. They should have just said, hey, who loves what we do? Mm-hmm. And we don't need fatal mistake of business 101 is to worry about what your competitors are doing instead of watering your own grass.
That's good. My closing thought would be, I wonder if someone intentionally was like, why don't we act like, what if someone had that thought? It doesn't sound like it, but if someone had that one, shout out to those. Hopefully they got some equity in the company. Because, well, that's the pod, man. That's the pod today.
Yeah, good work, man. All right, well, until next week, we appreciate you. Peace.
Appreciate you guys.